Real estate investment presentation using OneNote. Buy home versus rent calculation. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down in the 7100 Home Buy versus Rent Calculation tab. Also note, when using OneNote, look at the Immersive Reader tool. The presentations that are also in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, got our information up top, calculations on down below. Scenario we're looking into: the home purchase versus renting type of decision. Would it be better off from a financial perspective to purchase versus renting decision? Now note, we're looking at this purely from a financial kind of perspective here, and then you could factor in kind of the personal perspective and try to quantify that as well in terms of simply which would make you feel better off living in a purchased home or the renting home, and try to kind of factor that in. But we're looking at it here just from, in essence, an investment scenario in a similar way as we might do for a business type of situation if they were to invest in a large item like a large piece of equipment or something like that, something that's going to have an impact into multiple periods in the future. The typical way that we will do that is we'll try to break down the cash flows, the relative cash flows between the two decisions, and then use our present value calculations to determine the rate of return and whether or not that rate of return would be something that we're satisfied with making the initial investment for. So typically here, if we break this out, if we're in a renting scenario and we're thinking about investing in something, a home, that would be similar to like investing in a piece of equipment and on a business side of things. And we'd end up with an initial outflow. So you got the initial outflow, which would be the down payment generally. And then you'd have a change with the inflows that would happen, a change to the payments that would be happening after that, renting versus the cost of the payments that would be made on a purchasing side. So then you can look at the change in the payments over the time frame, say the 30 years or however long you expect to hold the home. And then the thing that's a lot trickier, or can be a problem with regards to the home, is that we're going to end up with that ending point where we still have the value of the home, which we expect to increase, which is a little bit tricky, because obviously if you have a capital project investment and you're investing in like a forklift or something like that, you typically expect it to depreciate or go down in value, which you can estimate generally, possibly fairly accurately. You can give a decent idea of what it's going to depreciate at. When you're looking at a value of property, which we're expecting to increase, which is one of the primary reasons we're investing in it in the first place, it can be difficult to know what the equity investment will be. And so we're going to have to factor that in, because that's going to be a huge cash inflow at the end. Now, also realize as you think about these kind of things, because the equity is going to be one of the bigger kind of components of this, and it's partially one of the bigger components because we're going to be leveraging a lot of what we're doing here with a loan. And that means that if things turn out well, obviously that can be good. If things turn poorly, the market goes down, that leveraging can have a multiplier that would work against us, right? So because of that type of situation, you also have to consider the liquidity of this as well, because as we think of the value going up possibly and the assets going up, we also have to consider the fact that we don't have access to it until we actually sell the property, or we get in some way a refinancing of it in order to access that increase in the value. So we'll have to consider that as we go through the process. Now, also note this is a complex kind of calculation because taxes would be involved, estimates are involved, so you'd have to customize it to your own particular circumstances as well. You can make it more detailed or less detailed, make different type of assumptions as you think about it, but the general idea is to break it down into kind of these cash flows. We do this in Excel, so you can work it in Excel if you would like, or just use the Excel template to see if you can kind of customize that to work on your own, whatever your own scenario would be. At least start there. There's a starting point. So our assumptions that we're going to make, if we were to construct this in Excel, once we have these assumptions set up, then we can change those assumptions and hopefully then set it up in such a way that we can adjust the whole Excel worksheet by just simply changing the assumptions, and then we can run different scenarios, which would be great. So we're going to say the purchase price, we're going to start with a large purchase price. We got the $750,000 on the purchase. We got the initial rent, meaning we're going to say that the rent that we're paying is going to be the $2,000. So $2,000 a month times 12 or $24,000. Now note that this may be kind of an extreme example. You might be thinking about a renting situation where the home purchase situation is different in size and whatnot, and taking that into consideration. But this is this is the assumptions we'll start off with, which will make kind of a more extreme kind of example, but then you can adjust these assumptions if you would like. So then we're going to have the rental growth rate. So the rental growth rate, you might want to think of as, in essence, inflation. So basically you would expect that year over year, if you got a yearly lease, it would go up by maybe inflation, which would be like 1 to 3%. In bad times or inflationary times, it might go up more than that, but you might consider some increase due to, say, inflation and so on. And then the property growth rate, we're going to say is 2%. Now, the property growth rate is another confusing factor. You would think it would also go up at least comparably with inflation, but depending on the area you're in, you might be investing there because you think it's going to go up at a higher rate than that. So you could vary the property growth rate. We're going to keep it the same here. Also note that that growth rate is going to be really important because we're going to be increasing our growth here, basically our return on the $750,000, even though we're only going to be putting, a portion of it down and only having a loan of $600,000. So we're getting a return on an amount much larger if there's an increase due to the leverage, the financing, than we otherwise would have been able to get with the amount of money that we currently have. So, but again, if that works against us, that leveraging effect, multiplier effect, if the market goes down, can have a negative decrease effect. So then we got the insurance, we're going to say is $700, and the maintenance. These are going to be things that we're going to have to pay when we purchase the home. When we rent the home, it's pretty straightforward. We just pay the rent. We might have some kind of renter's insurance, but we can just add that into the rental price and whatnot. And then we don't really have any maintenance, or we don't have any other kind of costs we have to worry about typically. So that'll be fairly straightforward. Therefore, we'll focus on the cash flows related to the purchase side. The expense growth, meaning that's kind of like the inflation rate. Again, we expect the expenses then to be more costly over time due to the devaluation of the dollar. So we'll keep all these at 2%, these growth rates, and you could vary those, but we'll keep them there for now. The marginal tax rate, remember the marginal tax rate is your highest tax bracket. So there's going to be multiple tax brackets that you pay taxes at. If you pick the average tax bracket, that's kind of like the average you pay on, but any differences in your taxes will be changed at the highest tax bracket, the marginal bracket, your highest bracket. Capital gains rate, if we have to pay capital gains, normally capital gains are at different rates. They're currently debating whether or not to increase. There's always a debate to change or increase the capital gains. It may or may not have an impact for a home purchase because you might get the exclusion, which could wipe out the gains. But if you are subject to gains, then you could have a situation where the gains are going to be different than your marginal rate, typically lower than your marginal rate. We're going to say 15% here. Property taxes, 1.5%. This is going to be subject to your state and local area, wherever your state and local is. What's the average on the property taxes? How do they increase property taxes in that area as values go up in the area? We're going to assume that as the value of the property goes up, they're going to reassess the property and charge us more property taxes. And then the selling expenses are going to be 7%. Those come into impact or effect when we sell the property. We're going to imagine when we sell it, we're going to have to take into consideration the 7%, that it's going to be the cost of selling. The loan amount's going to be the $600,000, which means we put the 20% down. If it's a $750,000 times 0.2, if we had that amount of financing, $600,000, we might have multiple loans that we would need or something like that. But we're just going to keep it at the $600,000 financing, 7% at the interest rate on the financing, loan terms 30 years. So given that information, we're going to do some of this loan information fairly quickly because we've worked on the loans in prior presentations. So I'll just kind of show you the calculations here. We got the payments on the loans based on this information using the PMT calculation would be the $3,991.81. We've got the annual payments, which would simply be that number times 12. So if I'm paying $3,991.81 times 12, we would have the $47,902. And the starting equity, the difference between, or in essence 20% of the 750, would be the 150,000. That's our initial down payment. We can then construct an amortization table, which we've seen in the past from this loan data. The 600,000 down up front, that's our loan amount. The payments at the 3,992, interest being calculated based on the 7%, and then the loan decreasing period to period, month to month. Once we have this set up, it should be fully amortized. And I'm not going into the calculation of it in detail. We've seen it in the past. But if we have our amortization table, which looks intimidating, but doing it in Excel, not too bad, it should be fully amortized after the 30 years. Now, one thing you could do with that table then is try to break it down into a year-by-year calculation, which we've seen in the past. One way to do that is with a pivot table. So now that we have the years broken out, I can break that out using a pivot table to the year-by-year calculation, which gives us a nice summary of the year-by-year information, the total outflows, the payments that we're making, which are quite significant because we had a large purchase, the sum of the interest, and then the reduction in the loan, and then the loan balance at the end of each year. Now we have this broken out on a 30-year time frame instead of month by month, 360 periods. So we'll think about this on a year-by-year cash flow basis now. So now we got the information to think about the cash flow. Now, when we look at the rental process, it's pretty straightforward. We're just going to be paying $24,000 each year. If we think about the purchase, we actually still have a higher amount that we're going to be paying than that. But because we're going to be increasing in the value of the property, hopefully the equity going up, then it could still benefit over a longer period of time. And that'll just be our starting point. You can then adjust this scenario after that. So, I mean, oftentimes many people will say you shouldn't basically invest in something if the rent is equivalent or something like that. But so you can change the scenario, meaning you would expect that if you put $150,000 down up front, that your payments would be equivalent at least, or lower possibly, to what you would pay in an equivalent rent. And again, we made kind of an extreme example here where you're still paying a substantial amount more because possibly the properties are different in size and so on. But it could still, over time, you could see how it could push even out given the fact of the value of the property. So again, we'll take a look at that in a second. You could change the scenario if you so choose at a later point, which we do in the Excel practice problem. So you can look at different rundowns of it. So then we can look at the property value. Now, this is going to be the major impact or increase that we're expecting because the property value is valued currently when we bought it $750,000. And if it was to increase just a modest 2% per year, which would be like inflation calculation, then we can see the increase each year would be the 750 times the 1.02 or 102%, 1 plus 2% would be the 765 in year 2, or we bought it year 0. So after 1 year, 765. And then if I multiply that times 1.02, 780, and so on and so forth. So you can see the property value going up given the substantial investment, quite substantially, even though we're increasing it only by 2% a year, we get that huge increase. Again, this one is going to be a place where we're making our assumption that it's going to be increasing, and that's going to take your expertise in terms of what do you think the rate of increase will be on the purchase. So then we can think about what's going to be the cash flow related to the purchase situation after I purchase it, which can be complex because it's not simply the mortgage payment, because we're going to have other things that are involved if we own the property versus renting the property. So what's going to be the cash flow before taxes? There will also be tax implications we'll think about, but before taxes with relation to the purchase. So in year 1, we've got the property taxes, which we're going to say are going to be the value of the home, which we have up here at the 750,000 times the property tax rate, which we said was 1.5 times 0.015. So that comes out to the 11,250. The insurance, we said, started at 700. The maintenance is 800. The loan payments, we said, are 47,902. That's not the payment monthly. That's a yearly for the year. So that's the monthly payment times 12. And that gives us a total, the 11,250, the 700, the 800, the 47,902 of the 60,652. We expect those to change over time. The property tax is going up because we're taking 1.5% of the increase in the property value. That might not happen at your particular location, but over time, you would think the state and local government may reassess your property from time to time to determine the current value of it and possibly then increase your property taxes on it. So we're going to be increasing that as the property value increases. You can look at what the regulations in your particular state and local area would be with regards to it. The insurance and maintenance were increasing by what we considered in essence to be inflation. So those are increasing by the 2% each time frame. The loan payments are the same because we fixed the loan payments. The breakout between interest and principal differs as the loan payments go on. However, the payments are the same. So in terms of simply cash flow, those will be the same. We're at the 60,907. So if we continue that all the way down, we got then our cash flow with regards to the 30 years for owning the home, which we can then compare to the rent. But we also have to consider the taxes, which can be significant as well. The two big tax deductions we could have for owning the home being property tax and interest. These are complicated taxes, so this is kind of a simplified scenario of it. Couple things you want to keep in mind. If you're renting, you probably have a standard deduction versus if you're buying, these two things may push you over to have an itemized deduction. But just because, for example, in this first year, if you had 51,807 all of a sudden, that you can itemize, that would be great. But the gap between the amount of standard deduction and itemized deduction is one where you're not really getting the benefit for that gap. Meaning, if you were substantially below the standard deduction and it took you $10,000, let's say $5,000 to get up to being able to itemize, even though you're taking 51,807 of total itemized deductions, it's really lower than that by the gap between the standard and the itemized, like the 5,000 that we were talking about there between the difference, because you would have gotten the standard deduction still would have given you that level of deduction without itemizing. So the only way to kind of figure those differences out is to actually run it, or the best way, I believe, get tax software, run the tax software with you having the deductions and without, look at the difference and see if you can figure out why those differences are being impacted. One big component would be if you're not itemizing to then being itemizing, then take that difference into consideration. Another big point is this property taxes are state taxes, and they currently, they might limit this is another big debatable issue. Should state taxes be deducted on the Fed? How much should they be? Because they cause government influence on the states and so on. So it might be capped. We capped it here at $10,000. If you have a substantially large state tax, say you're in large cost areas like New York or California or something like that, then that could be a substantial cap limiting the amount of deduction that you otherwise would have. Okay, so given those caveats, we're going to say that the property tax was deductible, but we capped it at the $10,000. So we're going to cap the property tax at $10,000. The interest we're going to say is the $41,807. This coming from our table that we got from the pivot table up top. This is not the total payments, but just the interest portion of it, $41,807. Notice the interest portion goes down over time, significantly down once you get down to the end of the loan frame. So even though the payments are the same, your interest deductions are gonna be much further down for that benefit. So just got to take that into consideration when you look at the long-term investment. You got the big deduction up front. It's going to be much smaller if you hold it to 30 years. So if you add those two up, these are the two items that could be deductible for taxes. And then we're going to multiply that times our marginal tax rate, which is our highest tax rate, 25%, not the average, because this is a differential. It might be a little more complex than that because it might it might push you up to a higher tax rate or something like that, or a lower tax rate. But 51,807 times 0.25 is going to be 12,951. So we're going to assume that we had these outflows up top, And then when we do our taxes, we're going to get an inflow in essence, or a reduction in taxes, a cash flow benefit of $12,952. So that means that the net cash flow that we take into consideration would be the difference between those two. In other words, this first one was our cash flow before taxes, which we calculated at $66,652 for year one, minus the benefit that we got that we're going to get back or reduce our taxes by $12,952. That's going to give us then $47,700. If we subtract those two columns out all the way down, this will give us our cash flow after taxes for the purchase scenario, not taking into consideration whether or not we sell it. So this is the cash flow not taking into consideration, in essence, the cash flow related to the equity that we would have to sell in order to realize, which we'll look at shortly. So we can compare that cash flow to the renting scenario. Now, renting was straightforward. We just pay $24,000. Obviously, these two are significantly different because of the scenario we put together, and we're still paying more on the purchase because of the scenario we set up here. So we still have a net, basically, outflow on the purchase versus the renting, which over time can still play itself out to a benefit possibly if the market value of the property goes up substantially because of the amount of leverage we have. So in this case, we put money down and we still have a net negative in terms of the outflow from purchasing versus renting of the $23,700 in year one, and you can compare those all the way down for the 30-year time frame. So these are the differences then in the cash flows if we go from renting to purchasing after having put the initial down payment cash outflow down up front. Okay, so once we have that, then we can think about the cash flow from the sale. So now we got to say, well, let's add in the fact that the value of the property is going to be going up by 2%. It started at $750,000, which is significant. What would be the cash flow if we were to sell, the property? We got to take that into consideration. So we're gonna imagine we sell it at each time period. Let's say after 1 year. After 1 year, it went up from 750, adding 2%. We're imagining it goes up to 765. The selling costs, we said, were 7% in order to sell it. So 765,000 times 0.07 selling costs minus the 765,000. So the net, actually, what am I doing? 765 selling costs, the loan balance that we would have to pay off, which we can get from the amortization table up top, our pivot table information, which was way up here. Where's the pivot table? There it is. Way up here would be the minimum balance after year one. So we still have a loan balance of $593,905, $593,905, $593,905. So we'd have to pay off the loan, and then we'd have the cash flow. So that would mean that we'd have the sales price, $765, minus the $53,550, minus the pay off the loan, $593,005. So if we sold it after 1 year, we'd have $117,545. That wouldn't be, in essence, our gain. That would be our net cash flow after having paid the cost of selling and paying off the loan. And then we'd have to consider if there's any tax implications. So if we didn't sell it in year, but instead sold it in year two, holding it on to another year, then we're imagining the sales price goes up by another 2% from 765 up by 2% to 780,300. Costs of selling, we're going to say now increase 7% of that, 54,621. Loan balance, if I scrolled back up and look at the loan balance that would still be outstanding, we'd have to pay off 587,370. Cash flow 138,309. If we waited 3 years, value we say goes up by another 2% to 795,906. Selling costs, 7% of that. The loan balance we can get from the table up top. We'd have the cash flow of the 159,831. Now the complex thing here, of course, is that we can only sell it one time. So we can think about what would happen in terms of the increase in the value, the equity. But from a cash flow standpoint, we'd have to sell it to realize that value. And so we have to think about what would happen if we were, in essence, to sell it from a cash flow standpoint at each of these time frames. So each of these time frames, each of these years being standalone assuming we hold it until 12 years. The value then up to 951,181, 66,587, 7% of that. The cost to sell it, the 489,492. The loan balance gives us then the 395,107 cash inflow. So this would be the cash inflow if we chose to sell it at the end of any given year. Now, there's also going to be possibly tax implications we need to consider. However, there's a huge exclusion if it's your home, meaning a 250 to 500,000 currently. So it could change over time, but that's a huge exclusion. But we can consider that. We could say, and we're going to assume a 250 single not married exclusion would look something like this. It would be on the gain. So it's not on the sales price. So if I sold it for 750,000, let's do year one, not year zero. If I sold it for 765,000 and the costs to sell 53,550, then in essence the costs, the net sales price, you can think of it, the subtotal between the two, 711,450. That's not my gain. I don't have to apply the exclusion or 250 exclusion to that. I compare that to the cost or basis, what I paid for it plus any kind of improvements or whatever. And so that was 750. So in this case, I had a loss. And obviously, if I had a loss, there's no exclusion necessary. The IRS isn't going to pay us for the loss either in there. But if I go down and I say, well, what if I sold it down here in like year 7? I sold it for 861,514. The costs of selling 60,306, so kind of like the net sales price after the cost of selling 801,208. I compare that then to the cost, which we say was 750. That's how much we paid for it. We're not going to say there's any improvements or anything to it that are going to adjust the basis. So that means the difference between that is 51,208. So that difference is what you're calling the gain, which would have to be excludable in order for you to avoid not having any tax implications. It's not the sales price, right? So that exclusion being 250 is fairly significant, even for single, married 500, quite significant. So we're below that amount here, and therefore the exclusion would wipe it out. We'd have no taxable gain, no tax implication. So that would be the case all the way down here until we get down significantly. And this being a large piece of property that went up a lot in value. So now if we sold it for $1,092,608, assuming it went up by 2% for 19 years, then we'd have to pay $76,483. The net sale, $1,016,126. The cost still at the $750,000. The difference then, our gain would be $266,126 in this scenario. And now the exclusion, because we're single, not married, we're assuming, capped at the $250,000. Therefore, we have $16,126 gain. So you can see it's a pretty big amount that it would have to increase by before we're subject to gains. And even if we're subject to gains, it might be subject to capital gains, which could have a lower rate, although, again, they're thinking about increasing it. But in our case, we said it was 15%. So we're going to say 15% in our example. 16,126 times 0.15 is going to be the 2,419. So we got a huge kind of exemption for capital gains for the home. So if I go all the way down here, 1,255,64, cost 87,854. That's the net sale in essence, 1,167,209 minus what we paid for it, which was the basis or cost, means the gains at the 417,209 minus the 250,000. That means we have the gain after the exemption, 167,209 times 15%. Now we're getting more significant balances down here for taxes down here. But if you were married, you can always, before you sell it, if you're married, it would be 500,000. You have to make sure you're in compliance with, the rules of married 500, which again, huge exemption. So in any case, you'd have a tax implication that would have, and then we got the cash flow after taxes. So the cash flow after taxes would be the cash flow before taxes that we had up top that we calculated. And then the tax implications are really happening kind of at the end here. So like at year 30, we had the 1,263,425 minus, if we had to pay these taxes at year 30, minus the 39,514 cash flow after taxes in year 30, we're going to say 1223911. So now we got the cash flow after taxes. So then we can use basically this comparison then to kind of figure out. Now this table is a little bit intimidating. We do this in Excel, so you can take a look at it and putting it together in Excel as well. But in essence, we're going to try to figure out what would happen in the event that we sold the property each year, so we can run the scenario assuming that we realize the gain, each of the 1 years, looking at the cash flow on a year-by-year scenario. So if I looked at, in essence, let's take year 1. If we look at year 1, and you're thinking about this as like a capital investment type of scenario, we put the initial $150,000 down up front, and then we had the difference in the cash flows as well as the sales price that happened in year 1. So if we sold it, we can calculate the net cash flows at negative. I'll take a look at another example, which is a little bit, let's do one that's a little bit more going on. Let's say we sold it in year 5. Let's go year 5. So now we've got the initial cash outflow. Now, normally in a capital project, you would expect the cash outflow up front and then a cash inflow benefit, meaning either cash inflow or a reduction in the cash outflow, a cash benefit in following years. Like if I bought a forklift, I would expect an outflow up front and then it to increase my efficiency and so on, and it cause cash inflows for the next. Here, we still have cash outflows, meaning I paid the $150,000 and I'm still paying more money for the purchase of the home from the paying off the loan and all the other expenses versus renting. But I've got this huge benefit if I was to sell it and realize the gain and that highly leveraged property that we're expecting to go up over time, which can be significant. That's kind of like the offset that I'm trying to emphasize here. So if I go up, where's this $23,700? That's the difference in the cash flow payments that we calculated up top. So we've got these differences to $23,700. The outflows if we were to purchase versus renting, still paying more if we purchase versus renting, $23,700, $23,585, $23,474, $23,366. That's where these numbers are coming through, $23,700, $23,585, $23,474. This last number takes into consideration that last difference and the inflow that's happening after year 5, which was this net cash inflow. So we got an inflow in year 5 that if we realized it and sold it, we calculated the sale inflow, 205,307, after taking everything into consideration, minus the outflow for that year that we have to look at for year 5, which was this one. So minus 23263, that gives us that 182,044. So the 182,043,044. So at this point in time, we still have an initial outflow that still caused more outflows to happen. But if I was to realize the sale after the increase in the property, which was $750,000, 2% increase, highly leveraged, then we still have a negative amount because it's kind of an extreme amount. But you can see that it's going down. Let's push it on over here. And we got kind of an extreme scenario that it's going down for quite some time. And then all the way out here in year 16, we're saying now we have a positive cash flow in year 16. It's still not good because if we calculated the rate at which this cash flow would be 0, it's 0.23%, meaning if you were to take these outflows and invest it someplace else, you can clear that, you'd get a better return on that. So even if you bring this scenario all the way out to 30 years, you get a positive amount. You get the 3,000 or the 377,512 because even though you had 30 years of outflows, you had this significant sale that you realized after 30 years. So over 30 years, you got a positive 377,512, but you result in an IRR, the rate at which that flow of payments would be 0 at the 2.05 due to the fact that it's it's over 30 years. So again, we used kind of an extreme example to show that even the kind of emphasis on the increase in the value and possibly due to the leverage and the increase in the property. If the property didn't go up, then that could be a problem if it was just for investment purposes. Now, you could look at scenarios, and we will run scenarios where basically you put the down payment up front, which could result, if you put enough down up front, that you basically even out or possibly cause basically net inflows from the initial investment and so on. And you could then have scenarios down here. You could run different scenarios that would look like that as well. So you could use this worksheet to basically run different scenarios or get an idea of how you would do so. Let's just take a look at one more year. Let's take a look at year 20, I can remember 20. So we had the initial 150, then all of these represent the outflows that would happen during the year. And then if we realize the sale of the property, we sold the property after 20 years, we got that 664,404. Where does that number come from? That's going to be this amount from the sale after 20 years, which we said was a cash inflow after everything was said and done, 687,181, minus the outflow that we had for year 20, the net outflow between the two for year 20, which was right here. So that's going to be the 22776. 22776. Let's do it again. 22776, and then this cash flow year 20 minus the 687,181. That's giving us that 664. So in year 20, we got that 664. Year 20. It's over here. There we have it. So there's the 66404 about. So we got the benefit, or the 77, but still a pretty low internal rate of return, rate at which that series of payments would be zero. So like I say, a fairly extreme scenario here, but you could see how the impact of the equity value is the thing that can create the positive cash flows and have a significant effect due in part to the leverage. And then you could take this worksheet and basically run different scenarios, at least as a starting point, to get an idea of how you might construct different scenarios in a similar type of fashion. We do have those worksheets that you can work it from scratch, or you can use the worksheet just to use and modify as you see fit for your purposes.